What if I told you that the world's most powerful investors, controlling over $20 trillion in assets, just gathered in a room and revealed their biggest opportunities and deepest fears for the next 3 years? The 2025 Forbes Iconoclast Summit wasn't your typical Wall Street conference. This was Larry Fink from BlackRock warning about a recession, Ken Griffin from Citadel saying Trump is destroying America's brand, and Bill Ackman betting his entire fortune on a single strategy. These are the people who move markets with a phone call, and today I'm going to share exactly what they said behind closed doors. If you want to know where the smart money is positioning for 2025, this is the most important video you'll watch this year. Let me set the stage for what happened at this summit. Picture this. June 5th, 2025, in New York City. The 4th annual Forbes Iconoclast Summit brings together titans like Larry Fink, who manages $11.6 trillion at BlackRock, Ken Griffin, whose Citadel controls $66 billion, Bill Ackman running $15 billion at Pershing Square, and Callahan Erdoes overseeing JPMorgan's massive asset and wealth management division. These aren't just investors, they're the architects of global capital flows. When they speak, pension funds, sovereign wealth funds, and institutional investors worth trillions listen. The theme was seizing opportunities in a dynamic market, but what they revealed was far more dramatic. We're living through one of the most dangerous and profitable periods in financial history. The macro backdrop they're navigating is unlike anything we've seen. Treasury market volatility hit levels not seen since 2008, with yields swinging wildly as Trump's tariff policies created unprecedented uncertainty. Larry Fink, who called Amazon at $18 and has been right about virtually every major trend, told the room that conversations with BlackRock's clients are dominated by uncertainty and anxiety about the future of markets and the economy. He went further, saying, "The US is very close to a recession and may already be in one." This isn't some doom and gloom analyst. This is the man who manages more money than most countries' entire GDP. When Fink speaks about recession risk while inflation remains elevated and geopolitical tensions escalate, you pay attention. Ken Griffin delivered perhaps the most shocking warning of the entire summit. The billionaire who supported Trump and celebrated his election victory now says the administration is destroying America's most valuable asset: its brand. America is more than a country. It's a global brand, Griffin told the audience. For many around the globe, it has represented aspiration, and we are diminishing that brand. He specifically warned that Trump's trade wars are putting the U.S. Treasury market at risk, the foundation of global finance. The strength and creditworthiness of U.S. Treasuries, no brand came close. We put that brand at risk, Griffin stated. This is coming from someone whose hedge funds are all profitable in 2025, with his flagship Wellington fund up 2.5% despite the volatility. When Ken Griffin warns about tarnishing America's financial reputation, global investors take notice. But while the macro picture looks treacherous, these titans see massive opportunities in distressed debt and credit. Victor Khosla, who runs Strategic Value Partners with $22 billion in assets, told the summit there's a huge opportunity building in distressed debt markets. Despite seemingly stable surface conditions, cracks are appearing in private equity and commercial real estate debt. Khosla's firm has been capitalizing on this, restructuring companies like Wheel Pros and Hornblower Group, eliminating billions in debt while taking control of undervalued assets. For investors like SVP, if you take out the first 6 months of COVID, there's never been such a rich vein of opportunities over the last decade in an economy that's not in recession, Khosla revealed. His pipeline has quadrupled over the last 2 years, a signal that beneath the surface, corporate America is under significant stress. Callahan Erdoes from JPMorgan brought a different perspective, emphasizing U.S. economic resilience and the transformative power of AI. Her division is deploying AI tools that have increased advisor efficiency by 95%, allowing them to serve 50% more clients over the next 3 to 5 years. Things AI can't replicate will soar in value, Erdoes predicted, highlighting healthcare, infrastructure, technology, and energy transition as core growth areas. JPMorgan's AI investment saved the bank $1.5 billion through fraud prevention, personalization, trading efficiencies, and credit decisions. With analysts predicting another billion in savings, Erdoes represents the optimistic view that American innovation and productivity gains will drive growth despite macro headwinds. The AI discussion revealed a fascinating paradox that defines investment strategy. While everyone agrees AI will transform everything, the current phase is filled with hype and unproven business models. The summit panel noted that AI is in an early hype cycle with widespread enthusiasm, but many companies lack sustainable unit economics. Venture capital is becoming increasingly selective, focusing on startups with proven profitability rather than just growth. The consensus: we're about to see a classic productivity cycle. Initial failures followed by the emergence of major winners driving long-term gains. Knowledge workers will benefit most, but investors need to be cautious of bubble risks while positioning for long-term innovation opportunities. One of the most revealing discussions centered on the massive valuation gap between private and public markets. Private market valuations remain elevated compared to corrected public market multiples, creating significant risk if gaps close quickly. The era of startups operating like race cars with high burn rates is over. Investors now demand companies that run like sedans focused on profitability and sustainable growth. This shift from growth at any cost to disciplined capital allocation represents a fundamental market maturity that's reshaping deal activity across all asset classes. Bill Ackman provided perhaps the most concrete investment strategy of the summit, unveiling his plan to build a modern version of Berkshire Hathaway through Howard Hughes Corporation. Pershing Square now owns 47% of Howard Hughes, a company that builds and owns cities. And Ackman is creating an insurance subsidiary to provide low-cost capital for long-term compounding. You take our investment track record, 23% compounded return over 21 years, and combine it with profitable insurance operations, and you make money on both the liability and asset sides, Ackman explained. This isn't just stock picking, it's building a wealth compounding machine designed to operate for decades. Ackman also revealed his continued bet on Fannie Mae and Freddie Mac, calling Fannie's balance sheet the strongest in its history as government-sponsored enterprises prepare for potential privatization. The summit identified three major megatrends reshaping investment landscapes: AI automation, revolutionizing industries from manufacturing to finance, private markets and alternative investments gaining traction. As investors seek diversification in volatile times, and the convergence of sports, media, and entertainment, creating new investment frontiers. The rise of women's sports specifically was highlighted as an undervalued opportunity, with massive growth potential and audience engagement that traditional metrics underestimate. What makes the summit's insights so valuable is the actionable takeaways these titans provided. Stay nimble amid ongoing policy shifts and market volatility to quickly respond to emerging risks and opportunities. Monitor credit markets and distressed debt closely for potential bargains as restructuring waves approach. Focus investment on real businesses with sustainable growth and profitability rather than chasing rapid expansion without an economic foundation. Embrace AI and technology-driven opportunities with caution, balancing hype against genuine long-term productivity potential. Diversify investments across public and private markets to manage risk and capture varied growth prospects. Stay vigilant on geopolitical and regulatory developments that could impact different markets and sectors dramatically. The power of optimism emerged as a surprising theme despite the challenging environment. Top investors remain optimistic despite economic and geopolitical uncertainties, betting on long-term innovation and market resilience. Historical data shows markets rebound stronger after periods of volatility, underscoring the value of patience and strategic positioning. Adaptability is crucial. Investors who embrace change and new technologies tend to outperform during dynamic market cycles. The courage to seize opportunities amid uncertainty differentiates successful investors from the rest, fostering growth in challenging environments. But let's be clear about the risks these giants are watching. Treasury market instability creates uncertainty in fixed income and broader markets, impacting risk appetite and capital flows. AI bubble risks could lead to sharp corrections as unproven business models face market reality. Geopolitical flashpoints around China, BRICS alliances, and Middle East conflicts increase market unpredictability and risk of sudden shocks. Cultural and regulatory shifts are disrupting sectors like sports, media, and energy, requiring adaptive investment strategies that can pivot quickly as conditions change. Here's the bottom line from the world's most successful investors. We're living through a period of extraordinary opportunity disguised as extraordinary risk. The same forces creating uncertainty, technological disruption, geopolitical shifts, monetary policy changes, are also creating massive wealth transfer opportunities for those positioned correctly. The key is distinguishing between temporary volatility and structural changes, between genuine innovation and hype-driven bubbles, between companies that can adapt and those that will be disrupted. The $20 trillion worth of assets represented at this summit isn't just sitting on the sidelines. It's actively repositioning for what these titans see as a once-in-a-decade opportunity to generate alpha through careful selection, patient capital deployment, and disciplined risk management. Whether it's Khosla buying distressed debt at discounts, Ackman building his insurance-backed investment vehicle, Fink shifting BlackRock toward private markets integration, or Erdoes leveraging AI to transform client relationships, the smart money is making bold moves while retail investors worry about daily market fluctuations. The next 3 years will separate the investors who understood this moment from those who missed it. The Forbes Iconoclast Summit revealed that the world's best investors aren't paralyzed by uncertainty. They're energized by it. They see recession risk as a setup for the next bull market, distressed debt as a once-in-a-decade buying opportunity, AI hype as cover for building real competitive advantages, and geopolitical tensions as catalysts for capital reallocation that will create massive winners and losers. Which megatrend excites you most? AI transformation, distressed credit opportunities, or private market disruption? Are you positioning your portfolio like these titans, or are you still thinking like retail? Drop your thoughts in the comments. Hit subscribe for more insights from the world's most exclusive investing events. And remember, in markets this dynamic, the biggest risk isn't losing money on a bad bet. It's missing the generational opportunities hiding in plain sight. The smart money has spoken. The question is, are you listening?
Stack it up real high. Come here to be in the know. Come here, enjoy the show. 'Cause it's Warren's money time.